mortgage rate. Let's deep dive and talk about what you can control in the uncontrollable. Stay on and watch. This is Kasama Lee, your community realtor. If you enjoy the content, you want to hit subscribe and the bell notification so you don't miss future video. Thank you for your support of the channel, the comment, the sharing, and the liking so that we could get this content out to more people. Listen, I wish we had some magic wand to control the interest rate, but we don't have that control. It's an uncontrollable piece. Let's talk about the 3 things that you can actually control as a borrower, as a potential home buyer. Number 1, your credit score. You can actually, believe it or not, put some control into improving your credit score. If you have not talked to a competent lender, I am more than happy to connect you with one, or speak to your real estate agent and they should be able to connect you with one. It's really important for you to understand that there are ways that you can actually do things to improve your credit score. Just remember this, the higher your credit score, the better your interest rate. Let's all sing together now. The higher the credit score, the better your interest rate. What that means is it lowers your interest rate. You can get a better loan package when your credit scores are higher. Ideally, if you can get it to like 720 at least in your credit score, that would be phenomenal. Now, I'm not a lender, so I'm going to put a disclaimer out there right now. That's why you should talk to a qualified, a competent lender who could educate you. First of all, they have to look at your whole credit portfolio and see what you owe and what you make, and if there are things that you can do. Sometimes it's paying down some of the loans, sometimes it's paying off certain loans. Don't try to figure that out yourself. I caution you, because sometimes you could literally jeopardize your credit score thinking that you're improving it by closing out credit card accounts when you should just keep them open. So it's a case-by-case basis, and it's important that you speak to your lender so they can walk you through that process. Number 2, what kind of loan are you getting? So there are all kinds of different loans that are out there, right? FHA, conventional, there's also VA, there are different types of down payments, and so on and so forth. It's important that you look at the type of loan that would best suit your credit profile. It does make a difference, and the payments can look completely different based on your scenario, whether you're getting an FHA loan or a conventional loan, and how much down payment you put into the loan. All of these things, I'm not going to get into the weeds of it or the details of it, because first of all, I am not a mortgage specialist. I've just worked with many of them, and I know that the scenario can look completely different depending on what type of loan you have. The other thing that I want to say about this is, if you are a first-time buyer, there are really great first-time buyer programs that are out there. For example, in Napa County, there is a program called the Proximity Loan Program. You can literally look that up. Some of the requirements is that you have to be purchasing a property in Napa County. You either have to live already work in Napa County to be able to purchase. Again, you can look up the guidelines. We will post a link in the description of this video if you want to check out the guideline. That's one. The other thing is, there are many first-time buyers programs, maybe grant programs, equity share type of programs that are available for first-time buyers. So if you can get your hands on any of those first-time buyers programs, it would contribute into your down payment or your closing costs. So it actually will make your loan package look better, which will in turn help lower your monthly payment. Again, talk to your competent and qualified lenders and ask questions about those programs. Number 3, the length of your loan. So there are different types of loan amortization programs that are available. The general one that you see a lot is the 30-year program. It's 30-year fixed rate. Some people refinance in and out of it, and so on and so forth. There are also, 5-year adjustable loan program that may be suitable for your situation. There are 15-year programs. There are all kinds of programs that are out there. Again, I'm not a qualified person to be answering any questions you may have, but you could bring these questions up to your qualified mortgage specialist to help you play out different scenarios so you know what might be best for you. An example that I just want to kind of elaborate a little bit, if you are looking to live in a certain area and you know that it's going to be just for 5 years, a 5-year adjustable program may be a better package for you than a 30-year fixed loan program, if that makes sense. Again, you need to ask these questions to your mortgage specialist and have them help play out different scenarios and see which loan program might be best for you. Well, I hope this is helpful a little bit and help enlighten the possibilities of you having control on what is controllable and not stressing out about the things that are uncontrollable, like what the interest rates are doing right now. Although it has dipped a little bit, it has decreased, so it's not so bad. I hope you are doing well and are staying cool in this heat, and happy shopping. Thanks for watching.